Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing nVent electric stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 13 billion market cap. They're trading at $78 a share and they have 167 million shares outstanding. nVent designs, manufactures, markets, installs, and services electrical connection and protection solutions in North America, Europe, the Middle East, Africa, and Asia Pacific. They operate through three segments: enclosures, electrical and fastening solutions, and thermal management. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looks real good, growing each year from 330 million to 480 million. Pretty good margins, 14%. That means they convert 14% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes from 270 million to 580 million. And their margins are improving each year, 17% in the trailing 12 months. Revenue is the sales for the company, and that goes up each year as well from 2.5 billion to 3.4 billion. And they have a good price to sales ratio. Price to sales is stock price over sales per share. It's about a 3.5. They pay a 1% dividend, which cost them $126 million. And they could cover that almost 4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 12 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $10 billion. We divide that by 167 million shares. And we get a calculated stock price of $62. They're trading at $78, so they're trading at a 25% premium. It's a sell according to the model. All these companies in electrical equipment and parts seem to be overvalued. Maybe I need to use a different model for these types of companies. There are 26 companies in the same industry as nVent, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 62 million in CapEx, about the average. Their debt to equity ratio is equal to the median. They pay a good dividend, third highest in this industry. They're generating a good amount of free cash flow, almost $500 million. They rank third in market cap. Their price multiples are a bit weak, at least weak relative to the median, but most of them are in line with the average. They generate 3.4 billion of revenue. So even though they have less revenue than Vertiv, they do generate more as a percent of their market cap since they have a better price sales ratio. And their 5-year annual revenue growth rate looks pretty good at 9%. If you put $10,000 into this company when they started trading, after about 3 years you would have been in the red, but the stock has taken off. Your $10,000 will be $39,000 today. That's a pretty good return in only 6 years. A 25% annual return, a 290% total return. Let's take a look at their financials. Here's their income statement, first quarter of 2024. The top of the income statement is the revenue, the sales, 875 million. That's up from 741 million. I always like to see how they generate their revenue. Of the 875 million of revenue, 440 million is enclosures, 290 million electrical and fastening solutions, and 143 million thermal management. North America is the bulk of their sales, 640 million, EMEA 180 million, APAC 49 million, and then just 3 million in the rest of the world. Here's a different breakdown of their revenue. Industrial revenue, 340 million. Manufacturing companies are industrial. All those Amazon shipping warehouses, that's industrial. Then you have commercial residential, 260 million. Infrastructure, 230 million. Infrastructure are things like mass transit, telecom companies, kind of like the basic necessities. Then you have energy, 41 million. Let's learn a little more about their revenue segments. Enclosures is about 50% of their revenue, electrical and fastening 34%, and thermal management 16%. On a high level, enclosures are meant to protect electronics and data. That includes data solutions to improve reliability and energy efficiency. An example is cooling solutions and power distribution solutions. Electrical and fastening, these are offerings to enhance end user safety, reduce installation time. Examples are cable management solutions, grounding and bonding systems. Bonding is meant to help people not get shocked. So if you touch something that has electricity inside it, you're protected, as long as you don't put your hand inside the object. But if you handle the outside, there should be a barrier to protect you, like a piece of plastic or a piece of metal. Grounding goes hand in hand with bonding. Grounding is using a wire to safely connect electricity to the ground. They also sell tools and test instruments to help provide efficiencies to contractors, and they sell their products to commercial, residential, infrastructure, industrial, energy. Thermal management is heat management solutions to protect people and items. They sell items to maintain temperature maintenance and temperature control. An example of something they sell is pipe freeze protection, surface de-icing, so to remove ice, hot water temperature maintenance, floor heating, fire-rated wiring, and leak detection. They did complete an acquisition of ECM Investors for $1.1 billion in cash, so a decent-sized acquisition. ECM is a leading provider of high-value electrical connectors, tools and test instruments, and cable management. They funded the acquisition with 2033 debt and a 2023 term loan facility. They also acquired Texa Industries for $35 million in cash, so much smaller. Texa is an Italian manufacturer of industrial cooling applications. They're going to market this product as nVent Hoffman. Their revenue went up 18.1%, cost of goods sold went up 18.7%, so their margins got worse since expenses went up more than revenue. Gross profit up 17%, it's $355 million. 20% of their revenue is SG&A, selling, general, and administrative expenses. 2.5% is R&D. So operating income, $159 million. Their margins improved from 16.8% to 18.2%. The reason operating margins went up is because SG&A went down. It went down as a percent of revenue. It increased $13 million, but as a percent of revenue, it went down from 22% to 20%. Their net income is $105 million. Last year was $94 million, an increase of 12%. Let's look at a statement of cash flows. Operating cash flow is $90 million, more than last year of $70 million, but less than their net income. Usually operating cash flow is higher than net income. The reason it's lower is all these negatives and changes in working capital. Employee compensation, a cash outflow of $26 million. This may be due to big bonuses, and other current assets, $12 million. They don't really define what the $26.1 million represents, so it's likely bonuses or big pay packages. In their investing section, they spent $16 million in CapEx. Last year, $17 million. In their financing section, they paid down $7.5 million of long-term debt, $32 million of dividends, higher than last year of $29 million. And they didn't buy back any stock. Last year, they bought back $15 million. Let's look at the company on Simply Wall Street. Its last price, 79, $14 billion market cap, up 2% in the past week, up 65% in the past year. They started trading in 2018 at about $23 a share. Their low point was in March 2020 at $14. But ever since then, it's only been uphill. They hit their all-time high a couple weeks ago at 85. So I think this stock has a lot of room to grow. Simply Wall Street's valuation is 78. 9 analysts priced this stock at 89. If you want to run the numbers through your own DCF model, I'll give them to you. 2024 revenue forecast, $3.6 billion. 2025, $3.8 billion. 2026, $4 billion. 2024 free cash flow, $530 million. 2025, $550 million. 2026, $647 million. So it looks like a lot of growth in the future for this company. They didn't have any debt in 2017. Then they added some in 2018, added $1 billion. Added another $1 billion in 2023. They paid a little down. It's $1.8 billion. But their equity is always a lot higher than their debt. Equity of $3.2 billion. And they don't keep much cash on their balance sheet, only $200 million. The salary of the CEO was $500,000 in 2017. Now it's $1 million. Total compensation, $9 million. Tenure as CEO, 6 years. In the past year, only insider selling, no buying. 93% of the company is owned by institutions, 6% by the general public. Their biggest shareholder is Vanguard at 10%, BlackRock at 9%. Those two always seem to be on top. The New York City company, Neuberger Berman, 1.7%. Mares and Power, the Minnesota company, 1.6%. Goldman, 0.9%. AMF Fonder, the Swedish company, 0.8%. Employee count up a little bit from 9,000 in 2016 to 11,000 currently. and the ticker only trades in one place, the New York Stock Exchange. Here's a recent article, the title, nVent Growth to Continue Further in 2024. Sales should continue to grow as demand remains healthy in most of the verticals. Vertical means you just focus on a particular segment of the market. Like if you sell ice cream out of an ice cream truck, then maybe you'll buy a company that makes ice cream cones. Maybe you'll acquire another company that makes the toppings for ice cream. Maybe you'll get a few cows and operate a small farm to get the milk to put into ice cream. Everything you do within your company, you try to control. Margin prospects also look good due to positive pricing and expected volume growth. They entered into a definitive agreement to acquire Tract from Palladium Equity Partners for $700 million. And they plan to operate Tract within their enclosure segment. Tract has more than 500 employees, and the deal should be done in the third quarter of this year. They're working with Citi to get bridge financing so they get a loan to acquire the company. Getting in cheap on nVent is unlikely. With a PE ratio of 22, nVent may be sending bearish signals at the moment, given that almost half of all companies in the US have a PE under 16. And even PEs lower than 9 are not unusual. They've been doing a good job at growing their earnings while other companies are going backwards. When a company is trading at a high PE, like 20, 30, 40, or even triple digits I've seen, then the investing community is expecting that company to beat the market. They had an earnings increase of 36%, but can they continue that? EPS has barely risen from 3 years ago, which is not ideal. 12 analysts predict earnings to go into negative territory, but the broader market is expecting a 10% per year growth. This is a pretty interesting company. I think it's a little overvalued now, but I think there's a lot of upside potential. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.